We've got markets looking pretty upbeat today, but it's certainly not all smooth sailing. Risks out there prevailing when it comes to whichever continent you're looking at right now.
Absolutely, Alishia. I think you're quite right. Overall, of course, our market obviously buoyed by whatever happens in the resources space due to the domination of our all-share index by the resources counters. So when the dollar is relatively weak as it is at the moment, you find that commodity prices denominated in dollar terms tend to be relatively high in nominal terms, and that often is a nice boost for our market. So when you look at the breakdown of resources, financials, industrials, the resources are doing quite well at the moment, but financials in particular not looking so great today. So it really is a bit of a mixed bag, and I think one should not be too fooled by what the overall market looks like and really pick your places very carefully in the market at this stage.
Of course, it's those rising commodity prices, as I was saying earlier, that's provided much of the impetus for the resources space. Let's though pit speculative demand against actual demand feeding through on the global economy. How are you reading that scenario at this stage?
Well, Alishia, I think there's a couple of things to look at. Let's start maybe with gold, which I think is probably the first thing that everybody looks at when there's heightened risk in the market. So following on from the Japanese disaster and risks rising coming out of Europe and the Middle East, I think the sort of safe haven status of gold often gets reaffirmed in times like this. So we're seeing gold at the double tops at 1440, certainly offering the safe haven status that many investors are looking for. Whether you want to call that speculative demand or not, I wouldn't quite call it speculative demand, but probably not real, sort of production demand there. Oil, the second one to look at, also quite a bit different, obviously because of the tensions in the Middle East. A different scenario there again. Concerns on the one hand about production, supply constraints, but on the other hand also concerns about demand maybe easing from the oil side because of the production problems, manufacturing problems in Japan. So oil is also a bit of a two-sided coin. And then there's sort of, for me, the rest of the commodity spectrum where you're really looking at your base metals, more sort of your real manufacturing and growth and demand-driven commodities, mostly demand coming from China. And I think that's the third sort of spectrum of commodities that we need to look at. And we often find quite different type of movements in our different commodities, depending on what the forces at play are on any given day.
Of course, on a sector basis, we've got investors choosing their positions very carefully. We had Michael Harris of Merrill Lynch yesterday saying that we're amidst an equity unfriendly environment right now. You've got to pick your places quite carefully. We've spoken about it on a sector basis. In terms of investment on a geographic basis, though, he was saying a major criteria is to buy for future growth, bankable growth with a multi-year view. How does South Africa fit into that scenario?
I think that's a very valid comment to make. I do agree in terms of an overall equity unfriendly basis. I think there's a lot of risks, there's a lot of volatility, and therefore one needs to really pick your places very carefully. When we look at the commodity spectrum and we look at the fundamental demand coming out of China, it really is the copper and the steel spectrum that stands out for us in terms of the commodities that would probably attract the most attention from China. And within that spectrum, if we look at copper, Meterex and Palabora Mining, for example, are the two stocks that are really the only pure copper plays that we have in South Africa. If we just focus on those two companies in particular, Meterex would certainly be our preference in that space, purely because they are much earlier in their cycle and therefore there's a lot more value still to be extracted, whereas Palabora is a lot more mature in its operations. It's a very large open pit. They are starting to go underground and they're experiencing problems and, of course, much higher cost base because of that. So those are the sort of aspects that one needs to look at when you want to get very specific about where to invest. That's just within the copper spectrum, and this is the same sort of argument that I think one needs to follow through just about anywhere and in anything that you want to invest within in the equity space at the moment.
Having said that, we know that the gold miners have been pretty unloved when it comes to that mining space. Harmony, though, up 3.4% yesterday. We had it come through as a top performer on the top 40 today as well, after an upgrade where we had Royal Bank of Canada raising its rating on the stock to outperform from sector perform. What is your view on Harmony and the gold miners in general?
Well, Harmony is the company that has gotten the most gearing to the gold price. So when we see the gold price itself at historically high levels, we would expect a company like Harmony to do particularly well because they've got such positive gearing to the gold price. So the coupling of the very high gold price and the upgrade by Royal Bank of Canada, I think combined to actually overnight in New York push Harmony's share price up by almost 7-8%, I believe. So I think what we're seeing in our market today is more catch up to that New York closing price last night than anything else. So I don't think there's anything stock specific other than just a positive bullion price, playing some catch up to the New York prices. To answer your question in terms of gold miners in general, I think the problem for South African miners are twofold. The one is that there's a very strong link between the gold price in dollar terms and the rand dollar. And where you find that the gold price in dollar terms might be looking very strong, it is often accompanied by a stronger rand dollar exchange rate, meaning that the gold producers in South Africa don't necessarily get the full benefit of the rising gold price. The second problem is that the South African gold industry is a relatively expensive gold industry in terms of its operating costs. It's not an easy game to play in South Africa, so on a global basis, South African gold stocks are often not the most preferred ones. But when you get the strong rising gold price, a very geared gold mine like Harmony will do particularly well, and that's what we're seeing today.
Well, Nerina, one of the sectors that seemed to have come back into vogue yesterday most particularly was the retailers segment. We've seen some of those counters falling back today, but looking at Klipsch out of the trading update saying that it expects earnings to be between 20 and 25% higher than the corresponding period last year. What are you making of Klipsch within that retailing space?
The trading statement certainly slightly ahead of current market expectations. A very brief comment from them and really just referring to very strong operations in their core businesses and also good capital management. About 2 weeks ago we had a statement out from government regarding a reduction in terms of the allowable logistics fee that drug retailers might be allowed to claim. Now, in terms of where this places Klipsch in terms of earnings, that might very well shave something off Klipsch's earnings base. But I think within the industry, it's probably much more of a problem for the smaller drug retailers. And over the longer term, I think Klipsch certainly stand to benefit and pick up some market share from some of the smaller players. So we do believe that more recent downgrades in terms of Klipsch's share price was overdone. And I think today's trading statement, a very positive number coming out from Klipsch, and certainly we would be a buyer of the stock at current levels.